things are a little bit crazy right now when it comes to money.
Let me talk. They're not a little bit crazy. They're pure crazy, right? I mean, this is financially the craziest times anyone has ever seen, unless there may be 100 years old, right, during the Great Depression. So this is crazy times. This is uncharted times. These are times that we're trying to navigate with what we know, with a great amount of uncertainty. And so when we have this uncertainty, it creates a lot of stress. It creates a lot of anxiety, because as humans, we're all about wanting to control and know. And this is a time that we cannot control and we cannot know.
Right. So, what are some of the big things that people should be kind of on the lookout for as we're all staying home, trying to keep the spread down, but businesses are closed, things like that?
I understand you're probably talking from the standpoint of finances, right? You're looking
Yes.
from a financial perspective. But
Yeah.
let me just say this. The finances are going to do what happens. There's a lot of things we cannot control. We can control what our decisions are in the midst of this, but the most important thing that I think we have to focus on is our health and our safety. And I think the government had figured that out when they decided to shut things down, because it doesn't help to have a strong economy when people are dying and they're very, very, very sick and can't engage in the economy. So that's the most important thing. But as far as what people need to be doing, um, there are things I think that we have to separate with how we're doing finances. And how we do finances, I think it has to be it's somewhat of a cautious state. I think we have to be cautious on how we're spending money, what we're spending money on. We have to realize that we might not go back to normal. Our income sources might be strained. So we have to be smart in spending our money. As far as how we're planning with money, we also have to be planning that we might not have income sources going forward to the same extent. So we have to be maybe a little more cautious in the amount of risk we take with our investments. We have to be cautious in aggressive planning, and just let some of this blow by. Some folks have changed their allocations in the markets. People tend to do that when they're a little nervous. It's very hard to time the market. If I gave you my opinions on where the market's going to be right now, when you actually share my opinions with others, I might have a different opinion at that time. So what I think about right now is really irrelevant, because my crystal ball don't work too good, and things change rapidly. We had a big drop. We had a fairly strong recovery. Where we are right now, my opinion is that people are discounting the effects of this virus as being fairly non-consequential. So if that in fact is the case, if this virus blows through and it's not much of an issue long term, then people got it right. If the virus is a big deal and it's longer than people think and it has more of a protracted impact on the economy, then the market valuations right now got it wrong, and we're going to see quite a bit more pain. So it's a little bit hard to say from that standpoint.
Okay, and the stock market really has gone up and down. We see that kind of as a trend whenever something that kind of scares us happens. Why is it important to know a little bit more about why that happens, how it happens, and what's coming next?
Right. So when we have stock market valuations, there are really two things that drive the valuations. One is the underlying economy. What's the stock market? The stock market is ownership in companies. And what you want to own profitable companies. And if companies are profitable, you're going to be paying more money for profitable companies. When are they going to be profitable? When the economy is doing well. So it just goes to reason, when the economy is doing well, companies are making more money and they're worth more. When the economy is not doing as well, they're not making as much money. Maybe they're losing a little money or just profitability isn't as high, so they're going to not do as well. That stands to reason, right? So that's the underlying valuations. And so when we have stock markets, we're looking at where the economy is going, and the stock markets are projecting where we think the economy is going to be. So the stock prices are a little bit of an indicator where we think the economy is going to be in the future. The other valuation is the consumer perception or the investor perception, and that tends to be pretty fickle. And that's what really drives more of the short-term ups and downs. Bad news, market goes up. Bad news, market goes down. Some earnings reports, good or bad, and it's it's a little more jerky. So where the markets might go something like this, just kind of might go like this based on the economy. It tends to go like this because of that herky-jerky reaction to news. And so we have to keep in mind that when there's bad news, that might be bad in the short run, maybe not necessarily in the long run, but everything gets kind of magnified and accentuated in the short term.
Okay. I know a lot of people are a little bit concerned because a lot of their retirement savings and things like that are based on stocks and the market and such things. So for those who are kind of getting to that age where they're starting to consider starting to pull from those 401ks or things like that, do you have any advice for them?
Well, the problem about selling from portfolios is if we are selling from temporarily low deflated prices. If we're selling temporarily undervalued stocks, then we're taking a loss on them. And my recommendation is for folks to not draw on the stocks at this time if they don't have to, because they've taken a little bit of a loss. Now, if you need the money, and it's the only place you can get it, you don't have much of a choice. But because we believe that down the road the stocks will be worth more, then we try to avoid selling at what we believe is a low point, particularly if it's a more of a longer term point. Between now and next week, next month, the point that we're in right now might be a high point. Well, based on longer trends, we are at a little bit of a depressed point, which we would try to not cash out if we don't have to.
So that seems to be one of the things that people kind of miss when they're considering what's going on. They say, "Oh, these companies are losing money. I don't want to be part of that. I need to cash out now before it becomes worse." Do you think that temptation is something that people should try and avoid?
So it's really more of a long-term strategy. Again, we're looking at the value of stocks down the road. We're trying to project what it's going to be down the road. And so similarly, any purchase we make, if we buy a house, are we saying, oh, this house is a good place to live now, or are we saying this house is going to be a good place to live the next 10, 20 years? Right? We make a purchase. Here's a car. Am I going to have this car for a year, or am I going to have this car for maybe 5, 8, 10 years? And similarly, let's say we were buying a business. We're saying, here's a business. Is it down? Is it up now? I mean, is this business going to be profitable for the next 10, 20 years? We have to have that same mentality with stocks. And the nice thing about stocks is that we don't have to be wed to them. We can sell them anytime. It's easy to unload a stock, right? Just go to market and sell tomorrow. But we have to have that same perspective. If we're buying stock, we're buying ownership in companies, and we're not really concerned about what it is now. We're concerned what it is down the road. And if we know that something is perhaps undervalued right now, this might be a good time to own it.
All right. So how can people, knowing what's kind of been going on right now, how can they look? What are some important things for them to look for going forward? How do you kind of make plans when everything that you had planned maybe not working out so well right now?
So I think there's a couple different plans we have talked about. One is financial planning, and one is maybe our specific investments. So if we separate that out on our investments, I think we have to realize that we're in a temporary circumstance that we have to be careful it does not is not something we overreact to and doesn't shape us permanently from just what's happening at this immediate time. From a planning standpoint, I think it goes to show that planning is important, but we have to have a lot of appreciation for our lack of clarity about the future and our lack of ability to plan things very specifically. I think we need to have a lot of flexibility in our planning. I think we have to have the ability to change what we're doing. We also have to recognize that we might not get it right, and we may need to readdress it, which also is why it's important to consider and reconsider our plans on at least an annual basis. As a financial planner, we try and do that every year with my clients, and just to assess and reassess on a regular basis if we're on the right path, if we have deviated, if it's okay that we deviated, we need to get back on track, or do we need to get on another track?
Okay, and then are there any trends that we're seeing right now that are different than what we've seen in the past? Are they something that we should maybe continue pursuing, or maybe not?
So when we say trends, I think we have to be careful that we're talking about true behavioral trends and not reactions. So for me, anything that's happened in the last 2 months, that's not a trend. For me, that's just people scrambling, people trying to get by, people trying to make sense out of a world that has stopped making as much sense. So prior to this, what were the trends? I think the trends that I'm seeing is that consumers are being much more careful what they're doing. They're much more strategic. They're much more thoughtful about what they're doing. So I'll give you some examples. People, I think in times past, just put their money and invested it and just say, I'm in it for the long run, without maybe being a little more thoughtful about what does that mean? What does the long run mean? And long run for what purpose? So if I'm in the long run for leaving money to my heirs, well, yeah, I can build a portfolio and leave that, but maybe I set up a life insurance policy and leave life insurance benefit to my heirs, if that's what the objective is. So I'm not relying on the assets to grow to leave to them. I can guarantee how much I leave to them if that's important to me. If I'm looking at income, maybe instead of saying, yeah, I'd like to just let it grow and I'll grab income from it, maybe we set up specific financial products, whether it's laddered bonds or it's annuities or some income generating vehicles that we know will provide income at some later date. So growth is less of an intermediary step. We're looking at other options for that end result that we're trying to accomplish. I think that's a big trend that I'm seeing. I'm also seeing, I think, people very aware of fees on products, how much things are costing. I think they'll be much more careful in who they're working with and really trying to ascertain if they're getting value from the people that they're working with. I think also demanding a little more expertise. I think the idea of looking at fiduciaries who have a best interest relationship with them is a trend. So I think consumers are being smarter in how they're handling their finances, and they're requiring more of the people they're working with. And I say good for them.
All right. Is there anything else that you feel like people need to keep in mind as we go forward here?
Right. Let me just think about that. I think one thing that people often do is they put undue pressure on themselves to be that they're not further ahead in some planning, that they're not further ahead in being able to retire, or their assets aren't quite what they thought they would be, or maybe they have a little more debt than they have. And I just want to give people a little bit of grace. I want to give people a little bit of room to breathe and say, we're on a journey here. Rarely do things work out the way we want them to, specifically the way we want them to do. But the question is, are we on the right path? Are we in a better place? Can we manage even if we didn't quite meet our goals? I think also there's a little bit of a lack of reality in how much people need to have to retire. Sometimes I have people tell me, "Len, I heard I have to have $2 million to retire." I don't know what that's based on. I mean, depending on what your circumstances are, maybe you need $2 million, but maybe you only need $500,000. Maybe you can retire on $100,000. And if you don't have any assets, maybe you can live on a Social Security check. I don't know. It just depends on the circumstances you're in. But it's just the idea to be realistic and not to put these pressures on yourself that, you're always going to be stressed. And then when you actually do retire, you feel like you've done yourself a disservice because you don't have more money. So I think that grace is important. I think it's important that people don't compare their situation to others, because they never really know details of their circumstances and maybe prices people had to pay in life and choices they made to build their wealth that maybe were detrimental to their personal life. So I think it's important for people to step back from that pressure and really enjoy life in the moment, planning for the future, but enjoying the moment. Some people are going backwards financially because they're not earning money. But I think some folks will 10 years from now say, those 2 months where I wasn't working were some of the most enjoyable times of my life. Yeah, and we went back a little bit financially, but boy, we reconnected with people. We had family times we didn't have, and those were great blessings. So, money doesn't revolve. Our life should not revolve around money. There's a whole lot more money to life. And I'd say take that from a financial planner. A lot more to life than that.